All right. Today is Sunday, the 7th of January. This is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. And hopefully that everybody's having a great new year and you're being a good boy and girl. You're following your new year resolution to the penny, right? And if you don't have one, at least for the ladies, here's a suggestion for you. This year, your resolution should be finding a man who's going to make your flaws look a lot better, like billionaire and investor Snake Bill Ackman. If you happen to be a plagiarist, he's going to make you feel a lot better by accusing the whole world of being a plagiarist too. If your cooking suck, he's going to leave a 1-star review to every restaurant in America. And if you have a hard time communicating and expressing your thoughts in 140 words or less, Snake Bill Ackman will make you feel better about yourself by making every tweet of his into an encyclopedia. And of course, the billionaire thing is just the cherry on top, right? Because women are so powerful and independent, they don't really need a man for money. All right, ladies? So this year, find yourself a man just like Billy Boy. And this Billy Boy, though, because you're probably too old for him. He sells his covered calls at 14. Even DiCaprio's like, hey, now that's creepy. And since we're talking about New Year resolutions, maybe you should add one to your list here, which is never, ever fly on the flying coffin, the Boeing 737 MAX. We told you in this program, doesn't matter how many fixes they do in this flying coffin, it's not going to work. It's just another disaster waiting to happen. And over the weekend, we got an incident involving the flying coffin over the city of Portland, where randomly a hole blew out in the plane just mid-flight. No biggie here. A little bit of an entertainment for you.
Yes, we are emergency. We are depressurized. We do need to return back to. We have 177 passengers.
This was the scene just minutes after Air Alaska flight took off from Portland in Oregon. A huge hole blown in the fuselage of the plane, 16,000 feet up in the air.
Now, what I don't understand is every time you watch a movie and there's an explosion in a plane and a hole blows out, you see everybody gets sucked into the hole and outside of the plane. The seats are flying, but here they're all sitting like nothing's going on. So either the movies are lying or, I don't know, maybe some pilot or an engineer can explain to us what's going on here in the comments. Anyways, who thought that the movies would lie? I don't know. In any case, the FAA now grounding more than 170 Boeing 737 MAX 9s, aka the flying coffins, after Alaska airline panel blows out. And if you've been following the Maverick for Wall Street on Discord, we have a put option trade on Boeing, the flying coffins, so if it opens gapping down tomorrow, it could be a nice payday for us. But I wouldn't count on it too much, because the entire government is owned by Boeing. And your beloved politicians and congressmen and congresswomen, they're all trading stocks. They're all gambling, buying Boeing and Apple and all of these stocks. So I would not be surprised that in the morning that we would get a headline that, the FAA now says, yeah, the Boeing airplane blowout was idiosyncratic. It was just a singular incident here. Nothing to worry about. Maybe we see the stock higher. So keep your hopes low here. And speaking about your beloved politicians, and again, they're all gambling in the stock market. That's their full-time job. The whole serving the people is just a charade for you to continue to go ahead and vote for the same shit over and over and over again, expecting different results. But Maverick, stop criticizing. It's always been this way. The government has always been corrupt. No, it hasn't. There's something called Constitution. The problem is we became a bunch of wuss. Pathetic weakness. And that's why you can't blame the politicians for gambling on stocks all day instead of serving the people. What is the punishment here? What happens if they get caught? And your beloved politicians who are trading stocks right now, they know that we got a problem. The problem is the shutdown. See, we kicked the can down the road last year, and now we have to face it. We're going to have another shutdown. Another shutdown means that we have another deluge of treasuries coming, which means that rates will go higher, stocks will go down. So all of a sudden, your beloved politicians come out today, before the market opened on Monday, and they say that, we reached a $1.59 trillion deal on top-line spending, which means that we're going to have a deal. We're not going to shut down here, folks. Please stop selling your stocks. Just wait for us to get out first, and then you can sell after we dump in your head. But folks, the stock market this year, at least so far, it appears to be that it's going to be one rocky ride. Worse than the flying coffin here. Why? Because we're going to be pretty much all about the data. See, the market had an orgy heading into the year under the impression that the Fed will cut rates for the good reasons, meaning inflation has been defeated, the economy is still holding, there is no need for higher rates anymore, we can cut rates down to zero, and inflation will not come back, and the only thing that will come back is real estate values, stocks values, wages will be great, no inflation, everybody's going to live happily ever after. The problem is there are two mandates here, the inflation mandate and the unemployment mandate for the Federal Reserve. And while they made progress on the inflation mandate, the unemployment mandate is still looking good. There's no problem here, so why screw around and cut rates and risk the fact that you might screw all of the progress that we've made so far on the inflation mandate? And we see reinflation in the economy. The other dilemma is, what if they wait and hold rates higher for longer? And all what that does is damage the underlying foundation of the economy. And sure, now you've made progress on the inflation mandate, but your unemployment mandate is now getting worse, and we see the unemployment rate moving higher. That's the recession risk. We talked about this dynamic, folks, in details in this channel. The dual risk, reinflation versus a recession. It is the hardest period of any monetary cycle because now you've raised rates, you damaged inflation, you see some damage in the economy, but the damage in inflation is not quite decisive yet, and the damage in the economy is not telling you that we are already in a recession, that you have to do something here to rescue the economy. In this situation, what do you do as a Fed chairman? Well, the Federal Reserve, since they made a mistake of not guiding the market, not guiding economic expectations to the peak interest rates, their goals in defeating inflation, they never really got it. They stayed in the passenger seat while inflation led all the way, and inflation is still in charge. The Fed is not. And for now, inflation decided to retreat, and the Fed is taking a victory lap, saying, look, we've accomplished something here. But what happens if they celebrate too much and they decide to do, let's say, a preemptive rate cut because they think that they've done enough when it comes to inflation, and the economy is showing some signs of weakness, and they decide to do a rate cut? Then inflation can come back. And now the Fed will have to raise rates again. You know where I'm heading with this. So this is going to be a tumultuous year. Unlike 22, which was, okay, the Fed is raising rates, meaning we sell stocks until we get any piece of data that says maybe the Fed will stop, and then we buy the dip when we have a bear market rally. Then we realize that we were wrong, and the Fed will continue to tighten, and the stock market keeps going down. 23 was the opposite. We keep buying because the Fed is done from 75 to 50, now to 25. Next thing, they're going to pause, unless, of course, it appears that they're not going to head that way, then we sell. And then we get another pause optimism and we buy. And after the pause optimism comes the rate cut optimism. This year, you can't really play that game anymore. You gotta face reality. And the action we got on Friday is the best illustration of the duality of the risk and how the market is gonna react to the data. For example, heading into the report on Friday, we talked about this in a video. We have a trader who made a massive bet that treasury yields will spike higher, meaning that bonds, the value of bonds, will drop down, leading yields higher. We made a video about this, and the assumption is that the jobs report will be hotter than expectations, which will lead to higher rates because we're going to push all of these expectations of Fed rate cuts further down the line. The expectations right now for a rate cut as soon as March. But the trader said, look, the report will come out hot, and maybe some information leaked to them, and they decided to go with this wager. So they saw that bond yields will go higher. And you know what? Initially, they were right. The report came out hot, erasing any excuse for a rate cut as soon as March. So we saw bond yields, and the 10-year yield, for example, moving significantly higher. But then they came down big. And the reason behind that is we got another piece of data from the services ISM report, which came out really weak. And then we've seen a recovery in the 10-year yield, and it closed pretty much flattish for the day. It was a roller coaster ride in the bond market, and it led to a roller coaster ride in equities. And this is going to be the dynamic here. We're going to be at the mercy of the bond market and the digestion of the macro data. We fed the market one hot piece of data in the jobs report, and the market said, okay, bond yields should go higher. Rate cuts would not happen by March. Equities go down. Comes a weaker recessionary services ISM. The market says, okay, maybe they're going to cut rates now by March because of this, and equities recover. Then comes the digestion. Oh, wait a minute, maybe the truth is actually between these two pieces of data that we just got. We see equities gyrating all over the place. But the bottom line is, it appears that maybe we've anticipated rate cuts, too many of them, and maybe a little too soon. And this is why investors are now reducing bets on interest rate cuts in 24. And that was solidified by the U.S. jobs data. Well, you got to remember that the rally in November and December of last year was based on the optimism of rate cuts. So now if we push that further down the line and we see bond yields improving and moving higher again, that's going to also shave off the excess from the stock market rally in the last 2 months in 23. And that's what we see so far. So it doesn't matter whether we look at the Fed or the ECB or the Bank of England. Expectations by the end of the year was, the Fed is going to cut so-and-so, the ECB will do this, the BOE will do that. And then comes the data from January 5th, and we see, okay, maybe they're not going to cut as much. Maybe they're not going to cut as soon as we anticipated. And this is the problem here. Even the Fed could be wrong. Even the Fed dot plots and the expectations of rate cuts in 24, the ones that they gave us in the December FOMC, they could be wrong because now we see more hawkish positioning of rate cut expectations after the data that we got on Friday. To begin with, this week we got the minutes from that FOMC, and it became clear that the Fed doesn't really know what the hell they're doing. They just look at the data and say, okay, well, inflation is going down. I guess maybe we'll do rate cuts next year. But then you look at the details and you realize that they have no idea. They're not really sure that inflation is hitting down to their target in a sustainable way. They're afraid that if they cut rates too soon, inflation might come back. And they don't see any urgency in cutting rates because the economic data unemployment remains pretty good. So all of a sudden we got a solid piece of data that forget about rate cuts by March. Absent of an accident, of a disaster, it's not going to happen. But the market said, yeah, whatever, the Fed can say whatever they want. They're going to cut either way until the data comes out. Because when the data comes out, you can't really negotiate with that. The data is the data and the Fed will follow the data. And again, folks, when we talk about the duality of the risk, reinflation versus recession, and any mistake by the Fed could amplify one risk versus the other. Rate cuts too soon, you got reinflation risk. If you keep holding on a tight policy for too long, now you're going to amplify the recession risk. Let's talk about the reinflation risk, the data that we got this week, and we begin with German inflation data. We got an acceleration of German CPI, and the reason is base effects, but also we see headline inflation moving higher because of the rebound in energy prices, even though core inflation is cooling off. So we see the phenomenon here of European inflation being impacted by the devaluation of the dollar, where commodities move higher, so headline inflation rebounds, but core CPI remains weaker. That's domestic, and that's impacted later on by headline inflation. Not to mention, of course, the geopolitical risk that we talked about in details this week, what's going on in the Red Sea. The situation in the Middle East is just awful right now. And what we see is container shipping prices skyrocketing. Doesn't matter whether we're talking about Shanghai, Genoa, Shanghai, Rotterdam, even Shanghai, LA, which is not really related to the Red Sea at all. But it doesn't matter. Insurance costs go higher, fuel costs go higher, premiums charged by these shipping companies go higher, and the end result is inflationary, that consumers have to wait more for goods and they have to pay more as the costs keep being passed all the way down to us in consumers. Then, of course, came the data from Friday, which is, here it is, U.S. payrolls increased by 216,000 in December, much better than expected. So what is the problem with that? Because everybody talks about soft landing. The problem with this is you can't really have rate cuts. So economically, it's not a bad piece of data. It's actually a good piece of data. But why is it bad for the stock market? It's bad for the stock market because the market is a cocaine addict. All what the market cares about is when will the Fed resume pumping cocaine into the market again? And it begins with rate cuts. That's what the market cares about. And a good piece of data like this says, hey, there is no need for rate cuts here. Why would you screw around and do a rate cut and then risk inflation coming back up higher again? Of course, folks, we say it's a good piece of data, but the devil is always in the details. More on that in a minute, but you see the month-over-month creation of jobs? That's moving higher again. See, if we were trending down, we could make an excuse for a rate cut because the Fed has to do a preemptive strike here and cut rates before we go negative in the pace of job creation. But we're not seeing that at all. We're seeing that the pace is moving higher again. So there is no reason to cut rates right now. Furthermore, when we talk about the recession risk, look at this. You got in blue core CPI, you got in red core PCE, and in pink, whatever that is, core PPI, and then you got in green average hourly earnings. You can see that all inflation data have been trending down, but according to the latest jobs data, average hourly earnings moved higher. So you see that green line, it kind of leads inflation higher. And if it continues to move higher here, Next thing you know, core CPI moves higher, core PCE, core PPI follows after that. That's the risk of reinflation, and this is why the Fed will be really, really careful before they cut rates, absent of an accident, of course. Here's another illustration for you. You can see that weekly earnings perking back up, hourly earnings perking back up, and that will probably lead the CPI higher. So that we still have reinflation risk in the economy here, folks. You can't dismiss that. We'll look at these sectors where job creation is. We have, let's say, low-quality jobs being offered right now. The majority of jobs being created in the economy right now, at least in the month of December, was in government. So the government keeps spending like a drunken sailor. That's the problem. They create jobs, sure, but at some point they have to cut this spending because the deficit is getting out of control. So the sustainability of government jobs isn't really that good. Then we have healthcare, and we talked about healthcare being the strongest sector in the economy, the most resilient sector in the economy. And we've seen in the past, even in recessions, the healthcare sector holds pretty good. The job security in this sector is pretty good even under a recession, and the reason is it is necessity. Just because we have a recession, people are not going to stop dying, people are not going to stop taking their medicine or seek healthcare. The other sector is leisure and hospitality, and the problem with this sector is it is really cyclical. So if we see consumer spending and purchasing power getting damaged, sooner than later, the pace of job creation in leisure and hospitality will begin trending down. And it's a really sensitive sector to the economy that we could see 1 month we're creating jobs in this sector, but the very next month we see massive job losses really quickly and accumulating month after month after month. The reason is if the consumer gets weaker, a lot of these companies lose their pricing power and their margins will deteriorate. Not to mention, of course, that they paid all of these inflationary wages in 21, 22 to hire workers because of higher demand for leisure and hospitality after the lockdowns. But what if the consumer pulls back? Money's not going to be hot. Your margins are going to be down. You have to get rid of employees. So the sustainability of leisure and hospitality is not really that good. Construction has been really hot, but it is weakening. It is moving from the hot to the icy. So all in all, when you look at this jobs report right here, it looks good, but then you look at the sustainability and you're not going to have any comfort here. Needless to say, with a report like this, you cannot really excuse any rate cuts as soon as March. And this is why the headline reads, Wall Street hopes for rate cuts may be too optimistic. Like they've been so many times before. We jerk off, then we realize that we shot the load a little too soon, and now you got nothing left, okay? And of course, the tendency of chasing a little too late of every party. Meanwhile, the hedgies are the ones who've been buying stocks in 23. They pump, they dump, lather, rinse, repeat. They give you a narrative and they send their dogs in CNBC, Wall Street Journal, all of these so-called media publications, and they spread the propaganda. And of course, what they want is to lure the retail mom and pops to follow the same narrative and fall into another pump and dump scheme. Now the hedgies are cashing out. Thank you so much for the rally. Bye-bye. Sayonara. And perhaps they see the same problem here. Maybe they saw it before, but they decided to pump either way because of the bonuses, and they had the power to do that and the right circumstance and the narrative to do so. But now as we have more data showing up, you can't do that anymore. So when we talk about what happened on Friday and the huge roller coaster ride in the bond market, we talked about the hot piece of data, the one that caused bond yields to go higher. What dropped them down though? What helped the market here in saying, no, you know what, rate cut expectations by March is actually reasonable? How about if we look at the services PMI or the ISM report, doesn't matter what you call it. And the most important details, the headline reading down by 2.1 points. So that's contracting, not growing. New orders down by 2.7 points. Perhaps most shockingly here, employment was actually down 7.4 point month on month. That's huge. And we know that the majority of growth in the economy came from the services sector, not from the manufacturing one. So if this sector is slowing down, we see a huge slowdown in the pace of employment in this sector. What does that say about the economy? It says that this is an economy heading into a recession. All of a sudden, rate cuts by March, they don't look that bad. And if we look at the details, since we looked at the jobs report, and I told you that the devil is always in the details, here it is. The December jobs report showed employers added 216,000 jobs for the month, while the unemployment rate held at 3.7%. But here's the catch, of course. Payroll growth showed a sizable gain from November's downwardly revised 173,000.
Uh-oh.
This is really amazing, and I think this is going to be a big part of the story. after the fact, of course. After the shit hits the fan, all of these downward revisions for jobs, they give us a number, a fugazi number, cooked number, and you have the impression that the economy is doing pretty good. And then they come back the very next month and say, oh, did we say that the economy created 200,000 jobs? Make that 130. We just made 70,000 jobs. The cooking got mixed up here. We ended up with an excess 70,000 jobs that don't really exist. We just made that up. Well, if that's the case, then isn't the economy a lot weaker than what we've been told so far? And doesn't that merit the Fed to cut rates? Because if they don't, if they keep holding, and the reality of the economy is, oh, wait a minute here, the unemployment rate in reality is a lot higher than the official Bureau of Kitchen Statistics numbers, then doesn't that make holding rates as high as they are for longer more damaging to the economy? Something to think about. And this is a major problem, folks. Look at this. Initial U.S. employment reports overstated by 439,000 jobs in 2023. So last year, there was 439,000 fake jobs. That's a huge number, folks. That makes a lot of difference here in whether we should cut rates or keep them as they are. The manipulation of the data will be a major, major story once again after the shit hits the fan. And oh, by the way, all of these jobs being created, quote unquote, created, listen to this, 8.7 million Americans, a record high, hold multiple jobs to make ends meet.
Come on, man.
So is it really the case that the economy is doing pretty good and firing in all cylinders, as the pumpers say, and we see jobs being created left and right? Or is it that folks getting more jobs to pay the bills, baby, which is skyrocketing because of this insane inflation that is still in the economy? So we see the unemployment rate going down a tick, but the labor market participation rate is dropping, further solidifying the evidence that this economy is actually weaker than what we are being told right now, and folks are being desperate to find multiple jobs. Again, since we're talking about the IC now, the recession risk, among the data that we got this week, here it is, job openings are down to 32-month low. This amplifies the recession risk. Furthermore, we got factory data. A U.S. factory gauge shows the 14th month of shrinking activity. Isn't that recessionary or not? Here's another one. Only half of Americans believe that they can pay off their December credit card bill. Recessionary or not? The consumer is getting annihilated out there. To begin with, when we look at the budget of any consumer right now, it is a nation of renters. Because the American dream is dead. It's been hijacked by so-called investors, foreign buyers, the oligarchy. They all own homes now. They buy all of the homes in the market, and single families can't really compete. And they end up being renters to these oligarchs and investors and foreign buyers. So we see that a lot of folks are now becoming renters by necessity. We have to rent. We can't afford to buy a home. Well, how much of your income are you spending on rent? We're now getting as high as 32%. Okay, if you're paying 32% of your income in rent, and we're assuming the other 20 on bills and utilities and car payment, groceries, maybe you're paying another 20% on debt, your student loans, for example, what do you got left here to stimulate the economy? And this is going to be even a bigger problem if we see interest rates holding higher for longer, because all of that debt will require more and more interest payments, and that's going to choke the consumer even more. So we see behavior already changing. We look at the cancellations of streaming services, for example. That's skyrocketing right now. Every penny matters. Every buck matters. Families are now scrapping, looking for spare change in their pockets, because that adds up. And this is the booming economy they're bragging about? This is Bidenomics? This is soft landing, as propaganda minister Janet Yellen says? Or is this a tragedy in the making here? Bottom line, folks, risk of reinflation, risk of a recession. That's going to be the battle. That's going to be the theme all year long until this shit hits the fan. Are we going to cut now? Oh, we're not going to cut. And the market will be up and down in an insane roller coaster ride. And this is why who's buying and pumping and dumping right now? The hedgies. The hedge funds are the ones who bought in 23 and the ones who are selling right now. The retail clients, the institutional clients, they're not really participating in the market anymore. Why would I chase garbage valuations right now and enjoy the roller coaster ride in the stock market, which is, by the way, is flat since 21? Meanwhile, I have a money market fund that is paying me 5% with no risk of duration at all. So we see that investors, retail mom and pops, institutionals alike, parking more money in money market funds, despite what the pumpers said on CNBC before year end, when they said, oh, one of the most bullish theories on why the market will go higher in 24 is all of those trillions of dollars in money market funds will come out and chase equities. Why would they do that though? Why would I jerk around when I have a safe 5% and get engaged in the roller coaster ride in the stock market when we're going to be pretty much under the mercy of the data? Now that doesn't mean that we don't have themes, really strong themes in the stock market right now, and we've seen a rotation in the beginning of the year so far. Rotation out of risk on, big cap technology stocks, small caps, into what? Into value stocks, into high quality stocks, good balance sheets, good dividends, but also defensive formation. So we have seen the healthcare sector, for example, benefiting from the rotation so far. Utilities, high dividend, defensive, also benefited from the rotation this week so far. Consumer staples, at least some of them. So we see, at least as we begin the year, a defensive posture, seeking healthcare, seeking refuge in good balance sheets, good valuations, and good dividend stacks, at least for now. That could change, of course, based on the flow of data, but there are also fundamental themes that will remain with us throughout the year. Among them, the fact that the healthcare sector remains strong. Among them, defense contractors. If you look at the size of book orders in major defense companies, all of them, book orders are skyrocketing. The geopolitics, the insane spending on defense all over the world now. That's a theme that's not going to change. We have another theme now emerging, which is the thing is back. Oh yeah, hospitalization for the thing and now moving higher. So we see the stock of Moderna, for example, being a top performer this week. Now all eyes are on Pfizer. Can Pfizer get their shit together and become a good performer this year after an abysmal performance last year? But of course, for this topic, folks, I think we're going to do a phone call with Dr. Fuchs. It's been a while since we called him. And last time when he was in a program, he said that you should buy Pfizer and short Moderna. That was a really good call back then. So we're going to call Dr. Fuchs here and see what he says about which stocks to buy for this recent resurgence of the thing. My hunch is he's going to say, buy Pfizer, buy Moderna. And by the way, we're going to call Pfizer CEO too. So we have a lot of phone calls coming in this program. But bottom line, folks, the so-called light at the end of the tunnel rally in December, low quality stocks, all of the credit rally that we got, that, oh my God, yields are going to go down to zero now. Interest rates are going down to zero all of a sudden. All what we're doing so far is shaving off the excess of those expectations. And now we're going to become under the mercy of the data and how they move those expectations up or down. This week, we have perhaps the most important piece of data, which is December CPI, December PPI. We can talk about the jobs report all we want, but the bottom line is the CPI and the PPI. Now, the easiest scenario in trading this week would be, hey, we continue to go down all the way till we get really oversold to the lower Bollinger Bands in the charts as we hit the Thursday's CPI number. And then the CPI comes out and it's not up by much, or maybe it's down a tick again, and we see a relief rally, oversold rally, we get a rebound. That would be the easier setup for this week. But again, they don't make it that easy, so we could see, for example, a rebound Monday, Tuesday, then we start to flatten out a little bit on Wednesday, maybe sell off a little bit before the CPI, and then we become at the mercy of the data from the CPI. That would be harder than, okay, if we go down, we get oversold, the element of surprise will be to the upside. But if we create a rebound before the CPI, it becomes harder to navigate. And I think that the most important number will be core CPI. Now, the expectations are that core CPI will be below 4 year on year. And again, if we get really oversold in the market, and indeed we get a core CPI 3.9, 3.8, or the market is going to rebound big. But if we, let's say, rally Monday, Tuesday, maybe flattish Wednesday, a little bit downside, and then comes core CPI, it's actually above 4, 4.1, 4.2, oh, forget about it. We're going to flush down big. So interesting week ahead. We're going to be here, folks. Either you're with us or you're naked alone. Let's move on and cover the stock market information for you. We begin with the closing of the indices on Friday, and here we go. The diamonds in the green by 25.77 points, or a gain of 0.07%. The Nasdaq also positive by 13.77 points, or a gain of 0.09%. The Spider up a little bit by 8.56 points, or a gain of 0.18%. On the other hand, the laggard, the Russell 2000, small caps, down yet another day by 0.57 points, or a decline of 0.29%. When we look at the performances of the sectors on Friday, what do we see here? Financials led the pack here. Maybe we have some short covering. Maybe since we've seen the gyration in bond yields, they went up initially, then they went down, leading financials, which are yield sensitive, to recover a little bit. Now, we have a lot of bank earnings coming out this week, so Financials will be really interesting throughout the week. Utilities, number 2. This has been the theme throughout the week. Energy, number 3. But we'll see what happens here with energy. We'll talk about this in a minute in the commodities coverage. But on Friday, the laggards led by consumer defensives, real estate, and healthcare. Let's contrast this with the weekly theme. What do we see here? Defensive. So bond yield sensitive, but we have 2 kinds of bond yield sensitive. We have risk on, that is technology, cyclicals, real estate, financials. And then we have yield sensitive, but risk off. Defensive, that's in healthcare, utilities, and consumer staples. So the hottest sector for the week was healthcare, followed by utilities, really defensive posture here. And then we got energy. That's because of the geopolitical risk and the reinflation risk from the data that we got so far in the week. The laggards, the risk-on theme, technology, cyclicals, real estate, all down big for the week. Money coming out, staying on the sidelines for a little bit, or some of that money rotating into defensive sectors such as value, healthcare, utilities. When we look at the breadth on Friday, NYSE 56% advancing versus 43% declining. The NASDAQ 39% advancing versus 58% declining. So at least in the NYSE's case, we're closer to the neutral line here, slightly positive. You combine that with the NASDAQ, which was a little bit negative. We have sort of a neutral close on Friday, and now we're going to be ready for the CPI this week. When we look at commodities, the closing on Friday, energy caught a rebound. Of course, there is hedging as we head to the weekend. The geopolitical situation in the Middle East is getting really, really bad, and anything could take place over the weekend. So we see some hedging here and buying WTI and Brent. The WTI was up almost 2.5%. Brent was up a little over 1.5% for the session. The gasoline RBOB was down a little bit, so this is bad for refiners when the RBOB goes down, but the prices of crude go higher. Diesel, heating oil was up almost 1.25%. Natural gas up by 3%. Natural gas was the winner of the week. We'll talk about that in a minute here. But we see softs, money coming out a little bit out of softs. The hot players of last year, cocoa, OJ, coffee, we see money coming out, but not so much rotating into sugar, lumber, and cotton. Lumber was not so much the laggard last year, but cotton and sugar were. When it comes to metals, what do we see here? Mixed messages. So the dollar went up, then it went down, then closed flattish. So we've seen a mixed reaction here in metals. The defensive, gold and silver. Gold was flattish, silver rebounding by a little bit. The risk-on metals, copper and palladium were down, but platinum was up. So mixed messages across the board. With the dollar not moving much, we see that live and feeder cattle futures were pretty much flattish, be it negative for the session, although lean hogs futures and meats continue to gather some steam here. Then we look at grains, wheat, a little bit of a rebound on Friday's session. Rough rice was up about 1.5%, but negative across the board, led by soybeans and corn futures all down. Now when we look at the weekly performance here, as we said, natural gas is the party boy with massive gains at about 15.5% for the week. But we've seen all energy commodities really gaining for the week. Natural gas, the reason is now we have a really good setup with the winter storms. So demand is increasing for natural gas. We have a powerful storm here in the US, at least in the Northeast, and of course, most importantly, across the Atlantic in Northern Europe. Now we see a huge winter storm, reducing temperature below average. Now all of a sudden they need natural gas. That comes from the Henry Hub. So we see natural gas futures moving higher. Let's move on to the big casino, the options market. What do we see here? The volume was a tick higher. Of course, it was options expiration, not the monthly one, but a weekly one. So we see the volume a little higher. Now we see that the spread between calls and puts are getting more balanced. We're not seeing excessive buying of calls. But again, we still have a bias here, a recency bias of buying calls versus puts. Now, if I see, for example, Monday, Tuesday, Wednesday were down, we see puts being bought at the ratio of, let's say, 55, 60% versus calls, then you probably want to take the opposite side of the trade here. But we're not there yet. For now, we just took a little bit of the excess from last year, and now we're going to be pretty much under the mercy of the data. What's notable, though, is in the month of December, the playbook was really easy by the market maker. All what you got to do is wake up in the morning, look at the SPY options with the expiration date of that particular day. Look at the puts, look at the highest number of open interest and change of open interest in the puts, and just move the tape a tick above to make sure that all of these contracts expire worthless. And the market was grinding higher, tick by tick by tick every day based on this playbook. So far this year, we see the opposite taking place. In the morning, you look at the SPY, you look at the open interest, you look at the change in open interest, and you move the tape a tick below the highest number of open interest and highest number of change in open interest. And this has been happening throughout the week and also in Friday's session. What is the message here? The market maker is now practicing maximum pain on the call side versus the put side as they did back in November and December. Let's move on to the unusual activities that took place on Friday's session. What do we see here? We see a lot of SPY put spreads. So we see a lot of hedging, a lot of betting on the downside using spreads. I'll just give you an example here. The 430 puts, they bought those for the expiration date of February 2nd. Then they sold the 400 puts, same expiration date. The expectations here are for the SPY to go down by more than 8% by then, but now more than 14.5%. And for this spread, they paid about 40 cents a piece for buying the 430 puts, and they received about $15 a piece from selling the 400 puts. All in all, the entry cost is reduced down to 25 cents a piece, and the dollar amount spent on this trade is in or around $1.8 million. Not a bad strategy if you want to participate to the downside or even hedge against your long positions by buying put spreads on the SPY, specifically given the fact that the VIX is still relatively too low. Next, we have the ticker DAL. This is for Delta Airlines. Somebody bought calls with expectations that Delta will move higher. Maybe they will because we have earnings coming out, and at least in Q4, the theme was fuel costs were down, jet fuel costs were down, but then you have the holiday travel theme, which means huge pricing power for these airliners. The assumption is that margins will be good. So maybe when these reports come out, we'll see Delta Airlines moving higher. The problem is now we have a monkey wrench that got thrown over the weekend, which is what happens with all of these downing of the 737 MAX planes. Would that impact the operations? Would that create negative margins in the next quarter, meaning the current quarter that we're in right now? If we shift the focus from airlines earnings in Q4 of last year to the guidance and the outlook for this quarter, then we have a problem with these airliners. Otherwise, if the concentration remains on Q4 and what happened already, then we could see rebounds here, and this is why the trader bought DAL, 46 calls, expiration date March 15th. The expectations, the name will rally higher and gain more than 13.5% by then. Paid about 70 cents a piece, tenor. This trade, all in all, spending about $1 million. And then we have what appears to be a strangle trade against DLO, and this is a South American company called D-Local. Somebody sees a big move coming, they're not sure where it's going to be, up or down. So they bought the 20 calls and they bought the 15 puts, all for the expiration date March 15th. Expectations for a move of about 15% in either direction here. They paid about 70 cents a piece for buying the 20 calls, and they paid about 40 cents a piece for buying the 15 puts, all in all spending about $1.5 million. Last but not least, what about ADM? Archer Daniels hasn't been a good performer, and somebody's betting for more pain to come in this stock. They bought the 65 puts for the expiration date February 16th, with expectations that the name will go down and lose more than 8% of its value by then. Paid about 75 cents a piece, tenor. This trade, all in all, spending about $750,000. What do we see here in the chart of ADM? The trader is obviously betting for more downside to come, but what do we see here? Maybe what we see is a pattern of a head and shoulder. We're about to give up the support in or around 70, and the trader sees the next support at in or around 65, so they're taking the shot that way. Now, if you look at the indicators, sure, the RSI is weakening, MACD is weakening. Maybe if we lose 70, we see a flush down all the way to 65, if not even below. Let's move on to the heat map and see what's going on here. This is Friday's heat map, and again, we don't see a consistent theme here. All what we see is some continuation of the weekly theme of healthcare, pharmaceuticals going higher, of high dividend names such as Verizon and AT&T going higher, some buying of energy, some buying of utilities, but also we've seen some profit taken by the shorts in certain names, at least in NVIDIA, AMD, and technology. And we've seen a rebound in banks, specifically regional banks, that went down throughout the week as yields came back up, but now maybe we see some profit taking yet again in regional banks, although the big banks been holding pretty good. And they gained more steam on Friday, but they have a test here as we see bank earnings coming out. If we contrast this theme with the weekly theme in the heat map, what do we see here? It is clear. Risk on is no longer loved. We see outflows out of risk on, so the big caps are down. Technology, software, chips all down. Even though NVIDIA has been the outperformer here, in contrast to other chips, but regardless, we've seen some outflows out of NVIDIA. You see outflows out of the rate-sensitive regional banks. You see outflows out of rate-sensitive biotech, even in healthcare. Although the value biotech, such as Regeneron, managed to perform pretty good. And of course, the COVID theme in Moderna did pretty good. As we've seen the dollar and bond yields rebounding, we see that any dollar/bond yield-sensitive sectors going down. So you can see that dollar-sensitive industrials, multinationals, such as Boeing, such as Caterpillar, those names went down. You look at metals, gold, silver, steel, copper, all of these names are down as the dollar rebounded. Any yield-sensitive name, such as, the Fed is going to cut rates and consumer demand will come back, all of these names went down. In cyclicals such as Nike, the restaurants, stores, they all went down. And what went higher for the week? Yield-sensitive but defensive, such as utilities, such as staples, names such as Coca-Cola, Kraft Heinz, Mondelez, Procter & Gamble, Verizon, AT&T. And then we've seen some demand for the defensive, high quality, but also high dividend names in healthcare such as AbbVie, Merck, Amgen, J&J, and even the Ozempic mania did pretty good. Eli Lilly, NVO, health insurance names, United, Cigna, all did pretty good. Value names in healthcare also caught some steam. Names such as MDT Medtronic, MCK Mickelson. We've also seen, since the yen going down and we see the dollar rebounding, we see Japanese auto manufacturers such as Toyota, Honda rebounding for the week. And of course, in industrials, the majority of names are down, but the defense contractors, Raytheon, Lockheed, NOC, all higher for the week. Now, we've seen also in the theme of geopolitics / the devaluation of the dollar / reinflation risk, we see some demand in energy here. Exxon did pretty good. The refiners, MPC at least, Marathon did pretty good. So we see some demand in energy at least for the first week of the year. Now, the rotation from risk on to risk off couldn't be any clearer than the financial sector of the market. Look at Blackstone, rate sensitive. Been rallying in November and December as rates, bond yields that is, went down. We've seen Blackstone rallying, but this week Blackstone is down over 8%. And the money rotated back into the value / rates going higher. That's good for us. Those are the insurance names such as Progressive, Travelers, MetLife, AIG. All of those benefit from higher rates. Now, when it comes to banks, yield sensitive, those are the regional banks. The smaller banks are down, but the big banks, JPM, Bank of America, Citi, Wells Fargo, all performing this week, but again, they have a test coming out as their earnings begin to show up this upcoming week. Now, of course, all eyes will be on Apple. It is the biggest loser of the week, at least in the big caps. And now, as they say, when it rains, it pours. So Friday, we got the news that Apple shares are down because the government is now preparing an antitrust lawsuit. I would not put too much stock in the lawsuit here. I think it's going to depend on whether we have some short covering, profit taking from the recent drop, combined with the oversold technicals. That could be the theme for Apple. But then, of course, as we hit to Thursday and Friday, inflation data matters more. Let's do the heat map for the ETFs for the week. What do we see here? TLT down, TMF down. What does that mean? It means we got a rebound in bond yields. Now, that's not going to be good for any yield-sensitive ETFs, such as the IWM small caps. That was down big for the week. Real estate, IYR, that's not going to like it. XHB Home Builders, ITB Construction, XRT Retail, all of these are yield sensitive. Did not do pretty good for the week. XBI Biotech, even though outperformed, be it down. KRE Regional Banks, yield sensitive, that's down. The only yield sensitive that are up for the week are the defensive theme of utilities, XLU, and consumer staples, XLP. Now, the dollar was also up, so we see any dollar sensitive names. Whether we're talking about the XLI industrials or the XME metals or GDX gold miners or even chips SMH, all down for the week. And of course, when the dollar rallies, we see that international markets don't do pretty good. So China, FXI, MCHI, EEM, all of these international ETFs were down for the week. But then look at the contrast between value versus growth, mid caps and small caps. Value outperformed. IWD, VTV, be it negative, but outperformed the rest of the market. Thank you to the XLV, where we see a lot of value stocks. XLV's healthcare. Now let's do some charts here and wrap it up. We begin with the SPY, the S&P 500. This is a daily chart. In the last weekly video, we talked about certain confirmations we need to look for. Confirmation for what? To book profits and to short. Confirmation number one was the rising wedge, which already played out last Friday, and we took some shorts based on that alone. The second confirmation is losing 473. We got that, and the last confirmation is losing 468. Now, did we get that because we're just down a touch below 468? And that's how traps are made. You get a little touch below the number that you're looking for, and next thing you know, they pop it higher again in a rebound. So you got to be careful here. We look at the MACD, we look at the RSI, we look at the Vortex indicator. All of these momentum indicators are saying that we have more downside to come. But will it be, since we have lost the 20 days moving average and we've retested it and it appears to be a failure so far, would it be a one shot to the downside all the way to the lower Bollinger Bands? And the SPY loses, let's say, 2% heading into the CPI. That's the easy scenario. because at that point you keep your shorts going all the way, you close them before the CPI, and maybe you take a shot that the CPI will cause a rebound. Now, are they going to make it that easy? That's my problem here. What if they give us a rebound Monday and Tuesday? They trade above the 20 days moving average. Then it becomes really tricky. It becomes, okay, now you're going to see more confirmations. You're going to see the loss of the 20 days moving average again. That will be a confirmation for the failure and the loss of the 20, and that's going to open the path for more downside to come. But in the meantime, it's not going to be easier to trade than, hey, let's just continue what we began here, get us really oversold, and then we get a rebound after the CPI. An illustration of that, if we move into the hourly chart of the SPY, what do we see here? A tick below 468, but we're also oversold in the hourly RSI and the MACD, and we could see that this is pretty much, could be a falling wedge pattern, but we get a break out of that. And again, that's going to make it really, really hard to navigate versus the easy scenario of, okay, let's go down to 459 or 460 before the CPI, then we catch a rebound after that. Even in futures daily chart, what do we see here? We're below the 20 days moving average. As you can see in the Bollinger Bands, we're below the white line, which is the 20 days. Ran a retest on Friday. Did not really get it. Does that mean a failure? It's a failure for now. And we'll look at the momentum indicators, RSI, MACD, Vortex, all pointing out for more downside to come, that we've lost a lot of momentum here. So can we go down all the way to the lower Bollinger Bands and then find support? That would be a downside of about 1.5%. If that happens before the CPI, you'll bet the guy that you're listening to right now will book profits from the shorts and take a shot that we could see a rebound after the CPI. But again, it might not be that easy if we remove the Bollinger Bands and the moving averages and we use the support and resistance lines. What do we see here? We got our target of 4,700 as support. With that hold Monday, Tuesday, Wednesday, as we head to the CPI, that's going to make it really, really challenging because it opens the path for a move to the upside and the downside in the aftermath of the CPI. But if we get to the CPI really battered, bruised, oversold, trading at about, let's say, 45.50, it becomes an easier trade to say, okay, the risk will be to the upside. Anyhow, for now, what do? We lose 4,700, then we have to trade more to the downside. If we keep 4,700 and we move higher, let's say Monday by a little bit, then maybe you have a rebound here that you can play Monday, Tuesday, and then take it out as we head closer to the CPI this Thursday. The Qs, an hourly chart, what do we see here? We lost a lot of support. We've lost 408, we lost even 400 in a series of bear flag after bear flag after bear flag. But we're getting really oversold on the hourly RSI here that we can catch a rebound before the CPI, maybe from, let's say, a saucer bottoming formation. We trade above 400 as we head to the CPI. That is a risk that you got to keep in mind here. If you look at the daily chart, momentum is all negative. MACD, RSI, Vortex, we've lost the 20 days moving average, and the assumption is why not just complete the move all the way down to the Bollinger Bands? That'll be a loss of about 1.5%. But again, folks, are they going to make it that easy? Or are they going to screw around, give us a rebound before the CPI, and then drop it down after that? But the question will become, even if they get us a rebound Monday, Tuesday, and Wednesday, and we're trading above the 20 days moving average again, can you really guarantee that once the CPI comes out, we're going to flush down? Or, since we're above the 20, we'll receive more short covering now, and the CPI takes us back to filling the gap above. Again, I am redundant, I get it, but as I told you, this week we have maybe an easier trade. We get really oversold in the daily, finish the move to the lower Bollinger Bands, and then catch a rebound after the CPI. Or the harder path for a rebound before the CPI and keep the path open for all possibilities in the aftermath of the CPI. When we look at the NASDAQ futures, what do we see here? We lost the 20 days moving average. We have lost a lot of momentum. Whether you look at the MACD, the RSI, the Vortex, doesn't matter. We have lost plenty of momentum. And the assumption is we finish the move all the way down to the lower Bollinger Bands, and that's that. Problem is, you wake up Monday, we're flattish. You wake up Tuesday, we're flattish. Now we're forming a bear flag pattern. If that is the case, if you're heading into the tape being short already, you're going to need some hedge, upside hedge, for the CPI by buying weekly calls. We talked about this in details before, how to hedge. If you're heading into the CPI long and you see that consolidation in a bear flag, you're going to need a hedge to the downside, weekly puts, the NASDAQ and the SPY, just in case CPI initiate the bear flag and we see a breakdown. The other scenario is, what if we Monday, Tuesday, maybe Wednesday, we catch a rebound into the 20 days moving average? That will be indicative of we're seeing some dip buyers, we're seeing some short covering from the recent drops, and the chart goes all the way back to the 20 days moving average. Anyhow, the IWM small caps daily chart, what do we see here? In this chart, we have lost the 20 days moving average. We have lost the gap fill. We have momentum declining and deteriorating, whether we look at the RSI, the MACD, the Forex indicator. The assumption is, since this is a yield-sensitive ETF, if bond yields continue to move higher, then the IWM should continue to move to the downside. We do have some support here in the zone in or around 185, 186. So we can drop all the way down there and then find some support. Ideally, and I know a lot of you looking at your Discord comments that you happen to be short the IWM. And ideally, you'd like to see the drop happening right before the CPI, get us all the way down to the lower Bollinger Bands. We book our profits, and then we see what happens after the CPI. But you always have to be prepared to what if it doesn't play out that way? What if they jerk around? We get a rebound to the 20 days moving average. Maybe a little bit above, maybe consolidating. What would you do differently in these scenarios? And when we look at the weekly chart for the IWM, what do we see here? We see that every time we got outside of the upper Bollinger Bands in the weekly chart, we got a drop down. We do have a reversal candle, and we have a confirmation now. And notice that in the last 2 times at least we've done that, we went below the 20 weeks moving average. The assumption here is, in time, in the weekly chart, the assumption should be that we're going to go down and cut below the 20 weeks moving average, specifically if bond yields recover. Here's the dollar. What do we see here in the daily chart for the Dixie? We're above the 20 days moving average, and you see the candle up and down on Friday's session, digesting the data. After the digestion, the dollar said, okay, I think I should be higher and above the 20 days moving average. The RSI is improving, the MACD is firming, the Vortex, it's a battlefield, we have no decision yet, but if the dollar makes it and it pops all the way to the upper Bollinger Bands, then at that time you'll see the SPY, the Qs, dropping down to their own lower Bollinger Bands. So again, if you're trading, if you're holding short or long positions in the indices, looking at the dollar will give you a really good guideline on how the tape is going to play out throughout the week. And if the dollar moves higher, then you got the old man gold daily chart. What do we see here? Holding on to the 20 days moving average here, as if gold is saying, yeah, I'm forming a bear flag pattern, but hey, dollar, give me some confirmation here. Give me that you're indeed popping higher, not just a fake out operation. And give me that confirmation. Once I have it, I'm going to flush down to my own lower Bollinger Bands. That's going to be in or around 2,000. Now, if the dollar fails for whatever reason before the CPI or after the CPI, and we don't see any change in this setup that we're seeing right now, then gold is going to hold the 20 days moving average and move higher after we see the dollar going down. Now, of course, if you're a gold investor, you'd like to see the dollar going down after the CPI, because that would be more sustainable than, let's say, a drop Monday and Tuesday for whatever piece of data. Then comes the CPI to reverse that. GDX gold miners daily chart, what do we see here? Again, if the dollar makes it up, it continues to move higher. The assumption is the GDX will go down, seeking support from the lower Bollinger Bands at 29. And ideally, for a confirmation, you don't want to go along the GDX again until you see the dollar going down after the CPI and you see the GDX trading above the 20 days moving average. Then you have a solid, reliable confirmation that you're going to go higher from here. Because right now, if you look at the indicators, the MACD is moving down, the RSI is moving down, the Vortex, you see the red line, the bearish line moving above the blue line, the bullish line. So we see that momentum is shifting negatively in the GDX. So you have to be careful here and have as much confirmation as you can before you go long. And the same goes for the SLV silver. Got to the lower Bollinger Bands, caught a rebound, but couldn't make it above 21.5, let's just call it that, or above the 20 days moving average. It's not going to be able to make it so long as the dollar is trading higher. When do we go long SLV again? If after the CPI, the dollar goes down and we see the SLV above the 20 days moving average. What about UK oil, Brent? What do we see here? Above the 20. RSI is improving, MACD is improving, the Vortex, mixed signal for now. Both the bullish and the bearish indicators are moving higher, indicating that we're not out of the woods yet. Some improvement, some encouraging signs here for oil bulls, but boy, do you need to move higher. All the way to the upper Bollinger Bands, expand the upper Bollinger Bands, get to 85, and then we're out of the woods, and the worst is behind. Yeah, what we get right now is news from Saudi Arabia, Aramco cutting the prices for Asian consumers. Will that impact crude oil prices down? Add more pressure, then if we lose the 20 days moving average, we're probably going to go down to the lower Bollinger Bands again. If we look at the 10-year yield, what do we see here? We're above the 20 days moving average, ran a retest Friday, and closed above. You look at the momentum indicators, RSI, MACD, Vortex, all positive, indicating more upside to come. And if that is the case, we have to finish the move all the way to the upper Bollinger Bands. That will be in or around 4.2%. Which ETFs and charts will be impacted the most by a move higher in the 10-year yield? The answer is XHB Home Builders. Daily chart caught support in or around 91.45. Ran a retest of the 20 days moving average but couldn't close above. If the 10-year ticks higher, doesn't matter, before or preferably after the CPI. If you happen to be eyeing a short in the XHB, you'd love to see the 10-year and the 30-year moving higher after the CPI, because that's going to be more sustainable than a pop Monday, Tuesday, maybe Wednesday, and then you have to be at the mercy of the CPI. In any case, a move higher in the 10-year yield and a failure in the XHB to move above the 20 days moving average will indicate that we have more downside to come, all the way to the lower Bollinger Bands at least. That would be a loss of about 5.5%. Another yield sensitive is the IYR real estate. Momentum indicators all negative, lost the 20 days moving average, ran a retest, couldn't make it above. If yields continue to move higher, before or even better, after the CPI, the IYR will move down and make it all the way to the lower Bollinger Bands. That'd be a loss of about 4% or so. Of course, if the CPI causes a drop in bond yields, then all of these charts are going to recover and move higher again. So what are we saying here, Maverick? How do we trade it? I would say that if you get the move before the CPI, and the IYR, for example, is already at the lower Bollinger Bands, we have a trade against that, by the way, against the IYR. We're probably going to book profits from that trade because we don't know what's going to happen after the CPI. And the risk would be at that point that the CPI will cause a rebound. If we don't move to the pullback target by Monday, Tuesday, Wednesday, we consolidate or move higher above the 20 days moving average. If we decide to keep the short positions, they're going to have to be accompanied by hedges. That what happens if the CPI pops the chart higher and the main trade becomes a loser, and the hedge should cover for that. Another yield-sensitive name is the KRE regional banks. And again, all the momentum indicators are saying that we have more downside to come. We lost the 20 days moving average, but we closed a touch above on Friday's session. So it's looking a little better than the IYR, a little better than the XHB, maybe because we have bank earnings coming out. But again, regardless of the earnings coming out, the KRE will still be yield-sensitive. And if we see that rates on the 10-year are moving higher, we are probably going to finish the move to the downside here in the KRE all the way down to the lower Bollinger Bands. That would be a loss of about 6.5% from this point here. What about the VIX, the Volatility Index daily chart? What do we see? Again, the problem with the VIX is the tight Bollinger Bands. Every time it wants to escape and move higher, expand volatility, those tight Bollinger Bands keeping it from doing so. And we're not seeing a strong enough of a catalyst, a fundamental catalyst, that causes the VIX to expand the Bollinger Bands by gapping above them. So for now, we're trading higher, but we're finding resistance at around 14.13 on the upper Bollinger Bands. What are the implications here? The implications are that probably the VIX is not going to be able to pop higher and expand the Bollinger Bands dramatically to the upside without the aid of a strong fundamental piece of data that really pushes interest rate cut expectations further down the line. And that's going to be the CPI. The CPI comes out hot, forget about it. The VIX is going to pop higher. You'll see a lot of hedging, 30 days plus, and the VIX will be able to make it outside of this range. Absent of that, if the CPI comes out cool, then you'll see the VIX moving back all the way down to the lower Bollinger Bands at around 11.67. You're going to see equities recovering again. Big Kahuna Apple, what do we see here in the daily chart? Big drop this week. We violated the lower Bollinger Bands, expanded them, which is bearish, not bullish. But again, you look at the RSI, and the question now becomes, we already said that we should short Apple last Friday, before the year began. And we got a juicy trade out of that when we gap down Monday. But do you enter a short right now, anticipating more downside at this point right here? Or do you wait for a rebound? Let's start with the latter, which is the case for not entering a short right now. Let's clean up the Bollinger Bands. Do we have a falling wedge pattern here, combined with an oversold RSI that could produce a pop? That's the case for not shorting right now. The case for shorting right now comes from the weekly chart because we've lost the 20 weeks moving average. The MACD is now showing negative momentum. The RSI is showing negative divergence. The Vortex indicator in the weekly showing that the bearish indicator is moving a tick higher. Bullish indicator in blue moving down. So closing below the 20 weeks moving average. As you can see in the chart, I don't have to point it out for you. Every time we've lost the 20 weeks moving average, there was more downside to come. And that downside could be all the way down to the lower Bollinger Bands. That'd be a loss of about 8.5%. What about Tesla, the souffle? What do we see here? On the hourly chart, we see a series of bear flags and we lost plenty of support. Now we have a support in this yellow line, the sloping line. Where does that come from? If we zoom out of the chart here, we can see that this was a line of resistance. Now it becomes a line of support. If we lose that, then we have 230. That will be the next support. Then after that, if we look at the daily chart, we're below the 20 days moving average, and the next support we have would be the lower Bollinger Bands. That will be in or around 232.81. Now what happens if the stock continues to lose after that, expanding the daily Bollinger Bands to the downside? It means that on the weekly chart of Tesla, if we continue to trade below the 20 weeks moving average, then we have the lower weekly Bollinger Bands this time around in or around 208, and that would be a loss of about, let's say, 12.25% from this point here. How about Nvidia? What do we see in the daily chart? We're back above the 20 days moving average. We're above 276, and for now, the daily chart looks as inverse head and shoulder, and the risk remains to the upside. On the weekly chart of NVIDIA, when do you become bearish in this chart? When we lose the 20 weeks moving average in or around, let's say, 261.5. And then you have a trade all the way down to the lower Bollinger Bands in the weekly chart. Other than that, so long as we trade above, the risk remains for expanding the Bollinger Bands to the upside. AMD, what do we see here? Daily chart. We got a correction. Removed a lot of the fluff from last year. We're below the 20 days moving average. Ran a retest Friday, could not really make it above. If the chart stays below the 20 days moving average and we see a failure, then the target becomes the lower Bollinger Bands in or around 128.5. That'd be a downside of all about, let's say, 7% or so. Now, if the chart begins to trade above the 20 days moving average, then the risk becomes to the upside that the gap can be closed, and that will be a gain of about 6% or so. At that point, it could also coincide with the upper Bollinger Bands in or around 149. How about the ticker BA Boeing? What do we see here? Daily chart. We are below the 20 days moving average, forming perhaps a bear flag pattern. If the bad news over the weekend impact the stock negatively, we could see a drop all the way down to the lower Bollinger Bands at around 239. That would be a drop of about, let's say, 4% or so. And again, the momentum remains negative in the RSI, the MACD, the Vortex. So that is the outlook for now. If we go down to the lower Bollinger Bands, can we find some support? The assumption is we should. Problem is, how bad of a gap would it be? Because a gap below the lower Bollinger Bands will indicate that probably the lower Bollinger Bands will expand and allow the chart to go down further. So that's really important to watch out for. Do we stop at the lower Bollinger Bands and then catch a rebound, or do we expand the Bollinger Bands to the downside? That would be critical for where the stock goes next. An example, look at what's going on in Palantir, daily chart. It is below the lower Bollinger Bands, and we played a rebound on Discord this week with a success. The trade produced 150% worth of gains as an intraday trade. And we could see some of that happening this week too. We could play these intraday trades and rebounds in Palantir, since it is oversold outside of the lower Bollinger Bands. And the argument here could be that, hey, this is a falling wedge pattern. If we clean up the chart, you can see a falling wedge pattern. We pop and we catch a little bit of a correction here. The problem is, regardless of a correction or a rebound in the name, you look at the weekly chart, we have lost the 20 days moving average, which is not a death sentence by its own. But then you look at the momentum here. The RSI is declining. The MACD is losing momentum. The Vortex, we're also seeing that the bearish momentum is gathering a lot of steam. If whatever rebound we get in the daily chart in Palantir fails to trade above the 20 weeks moving average at around 17, then the assumption is whatever rebound it is, it will be short-lived, and the weekly chart of this name will flush down to the lower Bollinger Bands. That would be a loss of about, let's say, 16.5% from this point on. But we get a downgrade on this name, so that could also be impactful in pushing the name down all the way to the lower Bollinger Bands. Bitcoin, tulips, what do we see here? Nothing to see. It's been holding within a tight range of the Bollinger Bands. You can see that this is going to require an expansion move, an expansion to the upside or the downside, meaning gapping above or below the Bollinger Bands. And that's going to create a lot of momentum. And then you follow that move, because that move will have plenty of juice for you to squeeze at that point. And the question now becomes, what happens as we hit closer to the BlackRock ETF? I told you that the risk could be that we have sell the news. And if it is, we're going to expand the Bollinger Bands to the downside. You can see a big move to the downside, expanding the Bollinger Bands. And that's going to allow for a flush down move to continue, and you'll be able to catch it at that point. And perhaps a more interesting chart here is the chart of MARA, Marathon Digital Holdings. It pulled back really big all the way to the 20 days moving average, caught support, but it's finding a hard time to trade above the highs of the breakdown candle in red. And now the risk becomes, as we see the RSI moving in negative divergence, as we see the MACD showing bearish momentum, perhaps a reversion to the mean, as we see the Vortex indicator showing negative momentum increasing. What if we see another loss of the 20 days moving average? That's going to be a confirmation of an inverse ABC pattern, and it could be a big one. So keep an eye on this chart here. And the last chart I want to talk about is the ticker NAT. This is a tanker play for the Red Sea geopolitics. We talked about it throughout the week. Let's hear what we said and then come back for an update. Nordic American Tankers Limited, this is the company, pays a huge dividend, trades at about $4.30. Not saying it has good fundamentals or it's immune from the risk, because it has a direct impact here. It passes through the Suez Canal. That's the major route for this company. For now, the company, whether it's going to pass through the Suez Canal or take an alternative route, their customers have to pay more. They can charge a higher premium. So we see that the stock has blasted higher, and it appears for now that it's forming an inverse head and shoulder. We have a sloping line of resistance. If the inverse head and shoulder plays out, we break above the resistance, then we have an upward trend in the stock. And here's the update. We made it above the sloping line of resistance, so we have a higher high now, and we have a confirmation that the inverse head and shoulder is playing out. So we have to stick with it right now, absent of the chart trading below, most importantly closing below the previous high, which is 455. If we lose 455, bad sign, we'll probably have to abandon the trade here. And with that, folks, moving on to the conclusion of this video, what do we have on the economic calendar this week? We have consumer credit tomorrow, and then Tuesday, the 9th, we have the trade deficit. Wednesday, the 10th, we have wholesales inventories, and most importantly, we have New York Fed President John Williams. But the big kahuna, the most important day, would be Thursday, Jan 11th. That's because we have the CPI, aka the CPI. And after that comes Friday, Jan 12th, we have the PPI. That's going to add more color to the CPI. But all eyes will be in the CPI on Thursday, Jan 11th, the most interesting day of the week. We're going to be here, folks. But this is all I got for you for now. If you enjoyed the show, please give us a like, subscribe, leave a comment. You know the deal. And consider joining us as a member. But with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.